wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 188, and in this episode we're reviewing the performance of the financial markets during the 48th week of 2025, and that is from Monday the 24th to Friday the 28th of November. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Wall Street this past week, the markets came back from the Thanksgiving holiday for a shortened trading session on Friday, which was the last trading day of November. And a pullback in tech stocks weighed down on the three major indices during the month as doubt persists around the future profitability of AI companies. The mood is back to more of a risk-on sentiment, given that markets are now pricing in about an 80 to 85% chance that the Federal Reserve will cut interest rates at its next policy meeting in December. A rate cut in December would mark the third consecutive rate cut following previous reductions in the months of September and October. Traders began raising their expectations for lower rates after the New York Fed president said that there was room for further easing of monetary policy in the near term. The Nasdaq Composite fell almost 2% in the month of November, bringing to an end a 7-month winning streak. Meanwhile, the S&P 500 and the Dow were slightly higher, posting their 7th consecutive winning month. The tech-heavy Nasdaq Composite jumped more than 4% during the week to close at 23,365, whilst the S&P 500 increased by almost 4% for the week before settling at 6,849, and the Dow Jones Industrial Average was up by more than 3% during the week to end the session at 47,716. In the government bond market, U.S. Treasury yields traded higher on Friday after a data center issue at the Chicago Mercantile Exchange disrupted trading during the early hours. It was a quiet week in terms of economic data, with investors looking ahead to next week when the Personal Consumption Expenditures Index will be released, and this will offer key insights ahead of the Federal Reserve's monetary policy meeting, which is scheduled to be held on the 9th and 10th of December. According to the CME's FedWatch tool, traders are currently pricing in about an 85% chance for a 0.25 percentage point rate cut during the last policy meeting for 2025. The yield on the short-dated 2-year Treasury note moved up by more than 2 basis points to close at 3.50%, whilst the yield on the benchmark 10-year Treasury bond was also up by more than 2 basis points before settling at 4.02%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the crude oil market, the price of crude was flat on Friday as the drawn-out peace talks between Russia and Ukraine kept geopolitical risks elevated, and with traders focused on Sunday's OPEC Plus meeting for clues about potential changes in production output. Signs of a peace deal between Russia and Ukraine initially pushed down oil prices, but these later recovered as negotiations appeared to be dragging along. There was no settlement on Thursday due to the Thanksgiving holiday in the United States. However, markets reopened on Friday with both contracts headed for a fourth consecutive monthly loss as expectations for higher global supply weighed down on prices. The price of the global benchmark Brent crude was up by about 1% for the week as it came to a close at $63.20 per barrel. Meanwhile, the price of the U.S. benchmark, that is West Texas Intermediate crude, this also ticked up by about 1% before finally settling at $58.55 per barrel. In the precious metals market, the price of gold rose by 1% to a 2-week high on Friday as expectations that the Federal Reserve will cut interest rates in December lifted demand for this non-yielding asset. Market expectations are pointing towards slow economic growth into 2026, which implies that the Federal Reserve is likely to continue cutting interest rates, and this in turn is driving more investors back into gold. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. The price of spot gold was on track for a weekly gain of 2.9%, and as it recorded its fourth consecutive monthly gain with an increase of 4.6% before eventually settling at $4,192 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling held steady as it traded just below 130 shillings versus the US dollar this past week. According to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.86 compared to 129.96 the previous week. Meanwhile, the sterling pound was priced at 172.23 and the euro was valued at 150.69. And on the regional front, one Kenya shilling was changing hands for 27.91 Ugandan shillings and 19.02 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.20. The International Monetary Fund has raised concerns about the stability of the Kenya shilling And in response, the central bank confirms that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by $58 million for a grand total of $11.95 billion, which is equivalent to 5.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently well-funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 9.25%, which is in line with the central bank rate, which is also at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 7.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 27th of November, and the central bank received bids totaling to 44.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 186%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate was relatively stable at 7.77%, whilst the 182-day rate was static at 7.80%, and the 364-day rate remained unchanged at 9.37%. In the primary bond market, the Central Bank of Kenya has published its prospectus for its December bond issue and is now inviting bids from the public. The central bank is looking to raise a total of 40 billion shillings through the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is a 30-year bond that was initially issued in 2011 and now has 15.2 years left to maturity. This bond has a coupon rate at 12% flat. The second bond is a 25-year bond that was initially issued in 2021 and now has 20.4 years left to maturity. This bond has a coupon rate at 13.92%. Please note that the interest accrued on these bonds is subject to withholding tax at a rate of 10%, and these bonds are now open for sale until Wednesday, the 3rd of December, when the auction will be held. At the Nairobi Securities Exchange, during the month of November, the equities market was on a downward trajectory, with the NASI declining the most by 3.8%, whilst the NSE 20 declined the least by 2.1%. The market's performance was mainly driven by losses recorded by large cap stocks such as Stanbic Bank, NCBA Bank, and Equity Bank, which declined by 6.6%, 5.7%, and 5.3% respectively. This performance was, however, supported by other large cap stocks such as Cooperative Bank and DTB Bank, which increased in value by 8.5% and 5.2% respectively. Up next is our topical issue, and this week we are looking at the latest World Bank projection for Kenya's economic growth. The World Bank has upgraded its projection for Kenya's economic growth to 4.9% in 2025. This is a significant increase from their previous forecast of 4.5% that was made in May this year. The World Bank referred to the upgrade as an upward surprise as economic activity accelerated faster than anticipated in the second quarter of 2025. The main driver behind this unexpected boost in economic activity was the construction sector. The Kenya National Bureau of Statistics reported that the real gross domestic product expanded by 5% in the second quarter compared to a growth rate of 4.6% for the previous year. Crucially, the construction sector saw a robust expansion of 5.7%, successfully reversing a contraction of 2% that was recorded just 1 year earlier. This major turnaround in economic activity is attributed to 2 key initiatives undertaken by the government. The first is the increased spending on the affordable housing program, and the second is the government's renewed efforts to settle long-standing pending bills that are owed for road construction. This injection of public project funding has stimulated demand for materials, transport services, and specialized labor. Additionally, other factors have also played a role in boosting economic activity, and these include the reduction in interest rates and the consequent improvement in credit growth, as well as the relatively stable inflation and the exchange rate. Economic growth, as measured by the gross domestic product, should ideally mean that people are earning and spending more money. This in turn should result in increased tax receipts for the government that should be spent on improving public services such as education, healthcare, and security. However, the gross domestic product, which measures the total value of goods and services produced within an economy, This measure has been criticized for not showing how income is divided across various segments of the population. In essence, what this means is that economic growth does not automatically guarantee the equitable distribution of income. The current reality shows that despite positive economic growth, the difference in income distribution is leading to a widening gap as the rich get richer and the poor get poorer. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurrig@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the meaning of life is to find your gift, and the purpose of life is to give it away. A quote by Pablo Picasso. Think about it. Thank you, and God bless.